Hi, I'm Todd Rosenbluth, Head of Research at VettaFi, and I'm joined by Jeremy Schwartz of WisdomTree to talk about currency hedge investing. Jeremy, thanks for joining me.
Todd, a pleasure to be with you.
It's been a tough year for international investing, particularly overseas in Europe and in Asia, but we've seen currency hedge investing hold up better. Why do you think that's the case?
Well, a simple answer is foreign currencies are dragging down the returns to unhedged ETFs. You have the euro down 8%, the pound is down 10%, the yen is down 15%. And just a reminder for people on the mechanics at work here, if you're a US investor, to buy a stock traded in euros, you first have to sell your dollars to buy euros to buy the stock, and then you have exposure to the European stock trading and the currency. So you have two sources of return and risk. And when you look at sort of broad international benchmarks this year, like the MSCI EFA index, it's down almost identical to the S&P 500, right around 20%. But roughly half of that move is currencies. So, the stocks themselves, just the local market returns on their local exchanges, are outperforming the S&P by almost 10 percentage points. But it's the currencies that are dragging things down. And Japan, in particular, is one of the most interesting markets. That's down just less than 6% as of here, July 5th. And so you've got the unhedged that's only down 5 to 6, the closer to 20 because the yen's down 15 again. So, I think there's a big question on these foreign currencies. I've been talking about how they don't provide great diversification, rather the opposite in a strong dollar move. It's the local markets that are more diversifying than the stocks plus this currency risk.
So does that mean the advisor needs to have a view on the dollar versus that local currency to make currency hedging make sense?
A lot of people think that, and they often tell me they don't want to make a call on the dollar. And the irony is, so they say they don't want to make a call on currencies, yet they're perpetually short the dollar, they perpetually long the euro, long the yen, long the pound, forever. And so, like, they say they don't want to make a call, but they are comfortable betting against the dollar forever. It's a very interesting dynamic. And I think part of it just comes back to the status quo, which is they've been doing that for so long and sort of mentally shift their mindset that to go the other, the timing of that switch is when they have to make the call. But in truth, the unhedged ETFs have a call that's perpetually short the dollar when the hedged ETFs are net neutral. They're hedging out the currency exposure you'd be getting when you are traditionally going to unhedge. So it doesn't get helped when currencies go up. It doesn't get hurt when currencies go down like they are this year. It really has no call. It is, again, neutral. And so I think for people who don't want to make a call, you got to think about what is your benchmark. But if you just say, I just want the local stocks in Japan, the local stocks in Europe, being hedged gives you that. It's a big mindset shift, but again, because of choosing the benchmark dictates what is active and what is not active. You got to really think hard about how you're benchmarking yourselves. What are the risks you want? And if you just think stocks are cheap around the world and you want the stocks and you don't know where the currencies are going, I think the hedged ETFs are a very good solution for that.
So let's talk about DXJ, the WisdomTree Japan Hedge Equity ETF. Tell us a little bit more about that product.
Yeah, so this was the one of the first currency hedged ETFs to take off. We had started back in 2009 with a broad international basket, and it took a single currency like the yen to really highlight the case. This was one of WisdomTree's first ETFs from 2006. It had a dividend weighted approach, so very value oriented into how we create the weighting mechanism. And so in a year where value is doing well, Japan DXJ is doing even well relative to the traditional cap weighted indices. It also has a bit of an export tilt to it, so it's sort of global multinationals away from just the local stocks in Japan like utilities or real estate. So it's really global multinationals from Japan. Now the sectors are very much like broad MSCI Japan when you look at the dividend paying market versus the non-paying market, and again that local nature, but it does have a tilt a little bit towards value. And so when you look at the PE ratios today, you're getting that basket 9 to 10 times earnings. It's really one of the cheapest baskets around the world. So in a year when US rates are rising dramatically, Japan's are not. And so you have a very nice equity risk premium in Japan, that's probably one of the strongest cases for DXJ, is just how cheap the stocks are when the interest rates are still stuck at zero.
Well, thanks, Jeremy. I think we laid out a good case for why Japan and why a currency hedge approach.
Before investing, carefully consider a fund's investment objectives, risks, charges, and expenses contained in the prospectus at wisdomtree.com. Read it carefully.